super excited about this workshop. And this is something that we all, as real estate investors, need to know, right? Whether you want to know it or not, this is something that we need to know. And we're just super excited tonight to bring with us a good friend of Dustin and the Rubicon family, Don. And Don, he's one of those guys you can just walk up to him and talk to him at any moment. He has a wealth of knowledge, and you all will see as we get to meet him tonight. But I love how his company, they do so many great things to help people protect their wealth. Unfortunately, if we open up to everything that they do tonight, we would be on all night long, which is a fun part. But they also have some events, and I'm sure he'll talk more about some of those events that he have where you can learn more. So I encourage you all to listen on in. We are going to save questions for the end. So please have your questions, or if you think you're going to forget it, you can post it in the chat, but we will answer them towards the end of the presentation. And so just a quick announcement before we bring Dawn up to get started is we have an event coming up very soon. It's going to be in November 7th through the 9th in Colorado. We're going to have Rubicon Multifamily. We are launching the first multifamily conference with Rubicon in November of this year. So if you want to be there, come and check out the conference. Use discount code Monopoly, and you can get a discount on your ticket. And I just want to encourage you all to come out to our events and meet some cool people like Don. So many people had questions with Dawn, and people were even asking questions to Dustin and myself, and asking questions about taxes and how they can save money. And we were like, we just got to bring Dawn to come back because he is the expert, and that's why we have him teaching this workshop. So without further ado, I would like to welcome Don. Don, how are you doing, man?
I'm doing awesome now. Dustin and I talked about running me, head to head with Kamala Harris tonight, the condition was that you guys have the cheering crowd that they have, and then oh, happy to be here. Thank you. Um, well, let me kind of let's introduce you this way. Let me introduce you to Bob. Bob is a really, really friendly guy. He's the kind of neighbor you want to have. He started doing wholesaling, looking for deals. After that, he did a couple flips, and now he still keeps doing flips, but he's got two or three properties of his own that he's holding, and the IRS looked at his tax returns and come back and labeled him as a dealer in real estate. What does that mean? Well, that means he's going to lose all of depreciation deductions on all of his properties for 3 years. So he has to claim the income but doesn't have the expense of depreciation to offset it. It means that he still has to recapture it when he goes back and sells it. But it doesn't matter that he didn't claim the depreciation. The fact that he could have, but the IRS didn't allow him, is not part of the thing. He still has to recapture. Means that all income that he receives, even rents, which is normally passive, is going to be considered active real estate, subject to 15.3% self-employment taxes plus his normal rates of income. It means all gains will be considered short term. So if he goes to sell the property, even if he's held it for a year and a day longer, doesn't matter. He's going to have to pay the more expensive rates. It means he's going to lose the ability to do 1031 exchanges for 3 years, even retroactive to the time he became a dealer in real estate. It means he can't do an installment sale, which means he sells a property and he's going to receive the money over the next 5 years, but the IRS is going to make him claim all that income right now this year, even though he hasn't got the money. That sucks. And that label is going to stick for 3 years. And regardless of how friendly he is and how outgoing it is, dealer status is like one of the worst things, one of the worst tax traps that a real estate investor can fall in. So tonight I'm going to break this down. Normally we break down presentations into 4 different sections. Income taxes, which for real estate investors can absolutely kill the deal. In his case, it wiped out all of his profits for probably the last 2 or 3 years. Income taxes can make or break a real estate investor. You have to learn to play the game, or it's going to absolutely eat you alive. Probate and estate taxes is a whole nother subject, because you build this real estate career, you build this empire, and someday you're going to have to pass that on. So we always want to begin with the end in mind. Probate and estate taxes are 100% optional if you will use the proper tools in a timely fashion. I tell people Jackie Kennedy died with a $93 million estate. She paid zero in estate taxes. She paid zero in probate. Why? If we can do that with a $93 million estate, we can really do that with almost anybody's estate if we can use the proper tools in a timely fashion. Threat number 3 is capital gains taxes. And I'll show you, and I'll talk a little bit about that tonight, and what that does to you long term, and then the threat of lawsuits. Now, what Dustin asked me to do was to really focus on threat number 1 and 3 tonight, and then we'll come back again another time and talk about estate taxes. I'm sorry, about probate and estate taxes, and then talk about lawsuits and legal structures and how we structure real estate deals for superb taxation and better and great asset protection and anonymity. But 2 and 3 we're going to have to put off to another night because I can't stuff everything in. But 1 and 3, that's what we're going to try to cover tonight. Okay, my name is Don Pendleton. As he mentioned, I'm not an attorney, I'm not a CPA, but I've written 5 textbooks that are used in law firms all over the nation. The last book that we wrote has sold 500,000 copies, and I'm really, for the last 25 years, I've run a hotline. So tens of thousands of questions come in from real live people that are in the trenches asking questions about, and most of them, I would say 90% of them, are real estate investors asking questions about structuring, taxation, estate taxes, trusts, all that kind of stuff. That's really, attorneys are really good at what they do. Most of the time, they're not very good at explaining things. That's really what is our specialty. We've run the longest running asset protection class anywhere in the nation. And when we bring these summits, as we call them, together, we're bringing in the very best of the very best of the best, to teach. Here's what we do, and we're bringing on people that own hundreds of properties, that have managed big estates, little estates, that have done tax returns for thousands of people. We're not bringing in newbies right out of college. We want people that are seasoned. We call them the America's Defensive Coordinators. Those are your instructors when you get to the summit. Okay, and before we get very far into taxes, know that I can teach general principles. I can't give specific advice to anyone. I don't know enough about you and your situation. You wouldn't want me to give tax advice to you if I can't see the whole thing. And obviously I can only teach, principles from a 10,000-foot view and say, but whenever I teach a principle, you'll always see, here's the IRS code, or here's the revenue ruling, here's where I get the information, so you can double check me. Okay, let's start with income taxes. If you're going to reduce your taxes, there's 3 basic rules that you need to follow, and then I'll give you lots of examples. Rule number 1 is that there are toll roads and there are free roads all the way through the tax system, and you get to choose. I used to live in the little state of New Jersey, and this was back in the late 70s, and what they wanted to do is they wanted to put a toll road through our township, and we got to vote on it. And what the promise was is that if they put in this toll road, we wouldn't have to pay property taxes, because all the people from Pennsylvania traveling to New York City would be paying our property taxes. It didn't quite work out that way, but that was that. And what we got to do as locals is we could pay the toll, maybe get there a little bit faster, or get a map and figure it out. And sometimes those free roads took a little bit more effort, but we could get there just as fast. And the police officers didn't care which road we took as long as we obeyed the laws on the road. Same principle applies. But I guarantee you this, if you don't get off the road at the right exit, you will be paying the toll. Free roads, there's no blinky neon sign saying freeway here, only on the toll roads. But the choice, my point is, the choice is always yours, and one is just as legal as the other. My stepmother, my wife's stepmom, hates that I teach taxes. Um, it is everybody should pay their fair share, and she hates it. So I sat down with her about 3 weeks ago. We were down in Southern California. Sat down with her and said, "Okay, so Eileen, you're getting ready to sell the house. You lived in it for 30 years. It's highly appreciated. Are you going to claim the capital gain exemption?" She said, "Of course I am." I said, "What if you didn't know about the capital gain exemption? So your first $250,000 is exempt from capital gains taxes." "Well, then I'd pay the taxes." "And would that tax return be correct?" "Well, yeah." "So you can either pay the tax or not pay the tax. As all I'm doing is teaching people about in the black area of the law. Here's the roads that exist. Here are the deductions that are available. If you don't know about them, you're probably going to pay the tax, right?" "Yeah." "Oh, that's what you do." She never really understood that. Rule number one, there are toll roads and free roads. You get to choose. We picture the tax code as being this immovable object that there are so many free roads. You just have to become educated, and maybe a little education on your part, and maybe have somebody, a tax planner, not a tax preparer, filling out the right little boxes after the damage is done, look at you and say, if we tweak this a little bit, this could save you 2 or 3 or 5 or 10 or 15% in your overall taxes. But the choice is yours. Rule number two, there are two different sets of rules. Again, you get to choose which one you go on. And I used to think two sets of rules. Okay, one for the rich, one for the poor. It's not that way. It's for those who have a business and those who don't. Let me show you how that works. If you don't have a business, let's say you earn $100,000, you're a W-2 employee, the very first thing that's taken right out of your check is your taxes. Let's say between state and federal, you're paying about 27%. Let's say your expenses are about $70,000. That gives you a whopping $6,000 to save for retirement and invest. Whoop-de-doo. Another set of rules is different. This is the business rules. And this says you make the same amount of money and the same expenses, but instead of being taxed on the 100,000, now you're going to be taxed on the 30,000. Assumably, you'd be paying a lower tax rate, and the difference is huge. In fact, there's a $17,000 difference. You imagine what could happen year after year after year after year if you had $23,000 to invest every single year. That's a big difference. So summary, if you don't have a business, you're going to earn it, pay the taxes, and then you get to spend whatever's left over. If we had a business, we could earn it, spend it, and then pay taxes. Okay, I'm not brilliant at the tax game, but I really like the right side of the screen a whole bunch better than the left side of the screen. I'm also smart enough to know I can't call everything in life a business deduction, but our goal is to shift as many things from the right side of the screen over to the left side as we possibly can. And I'll show you lots of examples. That's rule number two. Now, rule number three is you need to start tracking your effective tax rate. I'd love to know how many of you, give me a thumbs up if you know what your effective tax rate for 2023 was. Do I see any responses from this? Give me a thumbs down if you don't have a clue what that means. I'm not seeing anything. Charles, are we getting, is it, everybody's awake right there, right?
Yes, and so if you all know, so if you all can actually post in the chat to respond,
Okay.
or you can go to the reactions and respond. So just so you all know, I think some people might not know how to do it, but let's just make it
Okay.
easy and then go ahead and post in the chat. Respond to Don's question in the
How
chat.
many of you know what your effective tax rate was from last year? Just yes or no?
Go ahead and post in the chat.
No idea. Okay. Okay, thank you for your honesty. Appreciate that. Your effective tax rate, what it is we're taking the taxes you paid divided by the income that you made. And let me show you the difference between somebody who had a business and somebody who didn't. LeBron James a couple of years ago was treated as a W-2 employee by the NBA, and he made reportedly 124 million. He paid $43,000, 43 million in taxes. His effective tax rate is 34.9%. Compare that to some of the wealthiest business people who have tax planners, and you can see a huge, huge difference in their effective tax rate. Stop thinking that you're winning the tax game because you got a refund. It has nothing to do with that. As all that means, you paid too much along the way and they're giving you your change back. That's all it is. But your effective tax rate, if this year it's 20% and next year you can get it down to 18% and then to 15 and to 12, now you're winning the tax game. So this is state and federal, put them together, divide it by the income that you made. That's your effective tax rate. Okay, that's rule number 3. Now I'm going to give you some tax tips. I hope that makes sense to everyone. Tax tip number 1. Most of the real estate investors that I talk to have no clue how much they could be saving in tax-free environments. These are retirement plans. And the reason why is because the free road that we or that we kind of talk about is IRAs. And you look at that and you go $7,000 or $8,000 a year. Uh, it's just not worth my time. I'm busy flipping houses. I'm acquiring wealth. I don't have time to do this, and that's understandable. But remember, that rule is for people who don't have a business. All of you are real estate investors. You have the intent to make a profit. Therefore, according to the IRS, you have a business. You may not know that. It may not be incorporated. It may not be an LLC. But even as a sole proprietorship, you could be putting into retirement accounts 16,000, 23,000, $69,000 a year into retirement accounts, which are tax-free environments. Now, all of these things are called defined contribution plans because the IRS defines the contribution that you're allowed to put in every year. But then there's a thing called a defined benefit plan. This is working backwards. This is saying, okay, you're 58 years old, you haven't saved enough money. What do you think that you need to keep up the cost, the average lifestyle of which you're accustomed? Oh, you're allowed to put in up to 275,000. In fact, I've helped some students put as much as $350,000 into a defined benefit plan. It was an expense to their company, tax-free to them. Oh, baby. And they didn't tell you about that free road? No, they didn't tell you about that one. But they exist and they're real inside of the IRS. It's right there in the code, but you didn't know about it. And now if we could start acquiring wealth in tax-free or tax-deferred environments, that makes a huge difference. Okay, tip number 2. Most real estate investors that I talk to have no clue about the power of real estate losses because the word is misleading. I don't want to lose money in real estate. Good. I don't ever want you to lose money in real estate. But the IRS claimed it's mislabeled. Let's just say that. So let me break it down the very best I can. Let's say You invested $600,000 and purchased the property today. So today is what, July or August 22nd. My anniversary is tomorrow. I better not miss that one. Okay, but okay, so and the way that it would affect your taxes this year, I've invested $600,000. The IRS is not going to let me the land. They're going to want me to separate the land from the building. The land I can't depreciate. That's an investment. It is what it is. But the building, if it's commercial, it's 39. But let's assume that it's a home, and so we're going to spread that building over 27 and a half years. So this is 450,000 divided by 27 and a half. My loss in real estate is $16,000. Whoa. Now, did you lose money? No, you invested 600,000. But the IRS says, oh, you have a $16,000 loss in real estate. That's called depreciation. And you can use that to write off all other real estate, all other investment income that you made. You made money in the stock market. Good. You can write that off against that. All other investment income and up to $3,000 of W-2 income. And if there's more loss than that, then I can roll that forward to next year and next year and next year. Is there anybody that could not use a $16,000 loss in real estate? Probably not. I'd be great. Now, does it matter if I used other people's money? Does it matter if I used a mortgage or if I paid in? Nope, doesn't matter. Doesn't matter if you came up with all the money or if you mortgage. It doesn't matter. Oh, you invested $600,000, you get a $16,000 loss. That's pretty cool. But it gets better. That was a turnkey property. Now let's go to a fixer upper. I'm still going to put $600,000 in, but now the IRS allows me to deduct it differently. I still the land still $150,000. I can't touch that. Whether there's a building on, whether it burns down, washes away, it doesn't matter. The land is what it is. But what I'm going to do is I'm going to take the building and the improvements and divide that by 27 and a half years. Now I only get a $10,000 loss in real estate. But what happened to the repairs? Repairs is different than improvements. Improvements is I added on a garage, I added on, something. Maybe you want everything in life to be a repair. The IRS wants everything to be an improvement. You're going to have to figure that out with your accountant, is which is which. But if I had $150,000 worth of repairs, I get to write off all of that this year, showing a $160,000 loss in real estate. Ooh, baby, that's cool. And I get to write that off against all my other investment income, $3,000 of W-2, and roll that forward to next year and next year. Is that cool? But it gets better because there's a thing called cost segregation. And instead of spreading out things over 27 and a half years, what if we accelerate that depreciation and say, yeah, but the countertops are going to wear out in 5 years and the carpet might wear out in 5 years. So we're going to bring in a cost seg engineer, and they're going to put a price tag on every 5-year asset and say, let's, with bonus depreciation, and that's starting to phase out. I'll explain that a little bit later. But let's assume we're back to 22. That's easier. Now I get to write off 100% of that. Okay. And then we put a price tag on every tree, every shrub, everything that's considered a 15-year asset, and we're going to depreciate that this year. What that does is that accelerates the depreciation, which gives you more money to invest right now. Yes, you'll have less depreciation deductions going forward, but the key is cash flow and putting more money, more monopoly money, putting more hotels and houses on the board right now. That's the goal. Let's see how this all lays out. The land, I still can't depreciate. But what I'm going to do is I'm going to take the 15-year or the 27 and a half year assets, what's in blue, divide that by 27 and a half. instead of a $16,000 loss, it's only going to show me a $5,000 loss. Oh, too bad. But what happened to the repairs? I get to deduct those this year as long as I'm putting it in service by the end of the year. It's ready to rent, doesn't have to be rented, just ready to rent. And then I take the 15 and the 5-year assets, and now I have a $305,000 loss in real estate. Oh, baby. And this is how Trump says, I don't pay taxes because I have so many losses rolling forward from previous years. I don't owe taxes. Oh, cool. And most of our students don't, even people, we've got students that are making $1 million a year in the stock market, but they always buy a fixer upper at the beginning of the year just because of the real estate losses that they can use to write off all other income. Are you kidding me? Ah, cool. Tip number 3, you've got to learn to write off medical expenses. There's so many free roads available to you, but you don't know that. If you have a business, and all of you should have a business, and again, whether it's an incorporation, whether it's a sole proprietorship, LLC, taxes, C Corp, S Corp, manager, manage, member, manage, doesn't matter. If you have a business, you should be able to write off 100% of your insurance premiums. Even if I'm a W-2 employee and your company's paying 60% or whatever percentage and you're paying the rest, you still get to, as it's self-employed, you get to write off insurance premiums. However, if we had somewhere in your mix of entities, we've got a C corporation or an LLC taxed as a C corporation, and a medical reimbursement plan right out of IRS Section 105, and the language has been adopted in your bylaws or in your resolutions or somewhere in your corporate documents, now I can deduct for you and your family 100% of your deductibles, co-payments, prescriptions, herb supplements, anything that was prescribed, mileage to and from the doctor, the dentist, anything, chiropractic, special food, special physical, anything medically related that's prescribed, I can write off 100% of that. Oh, baby. And so many of you are not taking advantage of that. You have medical expenses, but you're not writing them off because it's subject to 7.5% of your AGI and all the other rules that shouldn't apply to you because you're a business owner. Now, if a C corporation doesn't make sense for you, at least look at a health savings account. It's one of the very few triple tax-free environments that are out there. And high deductible, there's no real definition. It's kind of an arbitrary term. What's high deductible? I don't know. It's not defined in the IRS code. Most of you understand if you had a traditional IRA, you would get tax deductible contributions, you'd get tax-free growth, but someday you got to pay the tax. Most of you get that. A Roth is backwards. I have to pay the tax now, but I get tax-free growth and I get tax-free deductions. Okay, well, that's good. What they don't really tell you is two things. If I had a health savings account, I get a deduction going in, I get tax-free growth, and I get free distributions as long as I'm using it for health reasons. Well, I plan on needing more medical expenses when I'm when I'm older. The other thing that they don't tell you is you can self-direct these HSA plans. It could partner on a real estate deal. Oh, even if it's 5 or 10% of the real estate deal, that now I can still contribute, and there's your contribution limits this year. Okay, my wife and I are both over 50, so we put $9,300 in as a family, plus the growth that's going on there. This is in addition to what you contribute through your IRA or your 401k or whatever. This is like a little savings account just for health for someday. Can I do the C corporation and the HSA plan? No, can't do that. But except in rare circumstances, probably not. Okay, but having that as an additional tax-free environment is a huge tax tip. Okay, how are we doing on time? Okay, we're doing good. Your business owners, all of you, you have a business, you have the intent to make a profit. Even if you haven't incorporated, you have a sole proprietorship. You have the intent to make a profit. The IRS, if you go to your account, they're going to read right out of the code that you can't deduct your cell phone unless you are keeping records of, 31% of my calls were personal, and nobody wants to do that. Here's how the court interprets the code. This is out of an IRS notice. It's a revenue ruling from like 13 years ago, but maybe your accountant didn't read this. And it basically says any business owner who requires that you have a cell phone. Can you think of a business in the United States that doesn't require the owners to have a cell phone? I can't. I don't know. Then the business can pay for it. That means they can pay for the cell phone itself and the monthly bill, and maybe internet, and without the need for record keeping. Does that principle apply to internet? Does your business require that you have internet? Mine does. Cool. Okay, so make sure you're deducting that. Okay. Most wealthy, really wealthy people are always paying their kids and their grandkids out of their business. Why? Because they're shifting income from a high tax bracket to a non-existent tax bracket. Because kids and grandkids can be making, well, anybody under 18 can be making or they can be making 14,600 without paying any federal income taxes, or in most cases, any state income taxes. Dang, what could I pay them for? Well, find a reason. I don't know. Maybe accounting or bookkeeping or employee morale. We've got people that run a residential assisted living. The little 3-year-old walks in, kid sits on grandma's lap, and she's better at morale than anybody. I don't care if they can cook or clean or website development or whatever. Sometimes we take pictures of the children and pay them a royalty. Now, there's a difference on my screen between active income and passive income. That 14,600 rule applies to active income. Passive income is a whole bunch lower. It's around 3,000. Here's a picture of my grandson. His name's William. He's now about 2. That was his little Ewok costume at Halloween, and he's just a happy little kid. And I have a written agreement with him. Every time I show that picture, I have to pay him $200. It goes right into his Roth IRA. Now, sometimes my screen gets my little button, whoops, there, sorry. Sometimes it gets a little messed up, and sorry, William. Oh, dang, there we go. Yeah. Have fun with this and find ways to be able to pay your kids out of the business. It's an expense to the business. It's tax-free income. And then what would I use the money for? Well, the very first thing I do with my kids and grandkids is I put together a Roth IRA for them. Now they have earned income. They could be putting up to, remember, $7,000 a year into that. Well, maybe I only paid them $8,000. Okay, so first $7,000 goes into a Roth IRA for kids. This is also a triple tax-free environment. The IRS assumes that you paid the taxes going in, but there were no taxes due. It's going to be so tax-free going in, tax-free growth, tax-free distribution. They can use it for college education. They can use it for first-time home buyer. They can use it for emergency medical expenses. They use it for, it's actually pretty cool what the things that they can do with it. If not, it stays for retirement. And could you help them manage it? We had a little 8-year-old girl set up on a stage. We were down in Orlando 5 years ago, and we were teaching, I think there was a class of 150 people. We set Maggie up on stage and said, Maggie, 8 years old, second grade, said, Maggie, what is in your Roth IRA? And she says, well, I've got 2 residential properties and a commercial property. And her mom whispers, and you got a business startup, so hard money loan. No, Mom, I got 2 of those. Oh, that's right. and she doesn't understand what hard money is, but her mom does because her mom's really savvy. Can you imagine an 8-year old with that type of wealth and what we're doing for her future? You cannot depend on our school system to train your kids in financial education. That only comes from you. But remember, I told you I'm paying my kid maybe $8,000. What happens to the other thousand or so? Well, it's going to go into a savings account for them. Who's going to control the savings account? Probably their mom. Okay, and birthday presents. Birthday presents are not tax deductible, but if we use the kid's ATM card, isn't it really the same thing? And so soccer lessons and piano lessons, and the kids tend to practice the piano a little bit better when the money came out of their account than if it came out of your account. And we're begin to teach our kids financial responsibility. Are you getting any ideas? I hope you are. Um, next tax tip. Most of you understand that for businesses, entertainment is no longer a business expense. However, the same activities could be 100% tax deductible if we called them a team building activity or a holiday party or an annual picnic or something. The IRS allows 100% deduction for those things. Same thing with meals and entertainment. Most of you know that restaurant meals are only 50% tax deductible if they're for business purposes. However, team building activities, holiday parties, company parties, those things are 100% tax deductible. So sometimes we're just using the tax code to your advantage. And now some of you might be thinking at this point, I've got a really stupid accountant. Probably not. Maybe it's not the accountant's fault. Maybe you're giving them the wrong information. When I teach a large class, in person, I like to ask the ladies, show me your purse. They reach down and grab their purse, and some of them are really small purses that would fit a cell phone, and some of them would fit a tablet, and some of them would fit the whole tower. But my wife does not own a single purse. That is true. She has a closet full of computer bags. Those are tax deductible. Purses are not. So sometimes you're giving your accountant the wrong information. Now that you have a business, start looking at this and say, oh, that was a cell phone case. Is this a vacation or is it a business trip? Is this a large monitor for your computer or is it a big screen TV to watch the Super Bowl? It depends on the information you're giving your accountant as to whether it's tax deductible and what little box he's going to put it in. Is this a tablet for business, or is this a guard dog for your business, or is it a puppy for your family? One's tax deductible. Okay, we're pushing it a little bit, but guard dogs and their food and their care are 100% tax deductible. Meals is it business or personal? Mileage whenever you get in the car, is it business or personal? Start collecting this information. I know that that's a free road and it's like a road map, and I have to do a little bit more work, but a mileage log is not that difficult, especially nowadays where it could be a little app on your phone. And I just keep a mileage log. I get in the car and say, this is for business, and it tracks your mileage. These aren't hard things to do. It just requires a different mindset. I'm teaching tonight from my home office, and every time I teach from my home office, my business has to rent. Okay, and so that money comes to me as long as I'm keeping it under 14 days a year. I get to rent this office for $300 or whatever's reasonable in my case, and I don't have to pay taxes. It's an expense from the business under 14 days. It's called the Augusta rule. I don't have to pay taxes on that. Oh, baby, mileage logs. Keep a mileage log. You'd be amazed at how that adds up. Just think about it this way. Any expense that big businesses, big corporations could deduct, you can deduct it. It's right there in the IRS code. You might have to restructure your business to be accordingly. You might have to have a C corp or maybe an S corp. Sole proprietorships can't deduct everything that's on that list. Sometimes you need the right language inside of your, but it's all about having the proper legal structure to deduct what you're doing, and stop asking the question, can I deduct this? Bad question. How can I deduct this? This is an expense I want to be able to deduct. How can I deduct this? How can I structure myself so that I can deduct it? That's a much, much better question. But when we teach a 3-day summit, we are going to spend every speaker that's there is going to be talking taxes of some kind or another. Some of them full on, that's all they're talking about. But every speaker brings in taxes to because it's a big part of asset protection. It's a big part of estate planning. And oh darn it, there's William one more time. Okay. 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 I hope I'm having a little fun with this, Charles. I hope that's okay. Okay. How can I deduct mileage on a for business realty when all my properties are out of state? Well, whenever you travel there, AJ, um, if you're going there to look at your properties, you can deduct it out of a business. Now maybe I have a management company that manages all of my properties. Sometimes, but if we don't have that business and you're just deducting it out of, let's say, your LLC that owns the properties, that would be a harder sell. So sometimes we, AJ, would need a management company for the purpose of, the business purpose is to manage my real estate or to manage my investments. And now I can deduct all kinds of things, educational expenses and cell phones and internet. And I can't deduct those things sometimes as a business owner owning the real estate or owning the stock market portfolio. But if I had a business, Charles Schwab can deduct thousands of things for their employees. Are you kidding? But it's because they don't own the investment, they manage them. So sometimes having that management company opens you up to a whole bunch of tax deductions. Okay, is there a specific type of Roth for children? No, it's a regular children's Roth, or it's a minor's Roth. And most of the time, your IRA custodians like Quest or whoever you're using, iPlan Group or IRA Club or whoever you're using, will give you a discount from minors. Are there are the distributions tax free? Well, yeah, there are specific rules for it, and you don't want them. There's a 5-year rule, but they can still pull that out for medical expenses. The same rules apply if they take it out before 59 and a half without it being a medical expense or education or first time home buyer or some other reasons. Yes, there are some tax implications, but no penalties. Okay, probate and estate taxes. I told you I'm not going to spend a lot of time on that, although that is a specialty. But probate and estate taxes, it's just like income taxes in that there are toll roads and there are free roads. But if you don't select the free roads, you will be paying the toll. And that is extremely costly. This is my wife's family's little estate. This was back in the 1800s. It's Mohonk Mountain Resort, if you're familiar with New York. It's about 100 miles up the Hudson River. It grew to be today's terms, in a multi-billion-dollar estate. They were the founding fathers of Redlands, California. They all owned all the upper land overlooking San Bernardino. I just one of the horror stories in that after everything was all settled, after there were 5 heirs to the estate, the estate planning was done on the New York side, but not on the California side. And they fought over that for 19 years. There were trustee fees and there were attorney fees and there were probate and there was estate taxes. When everything was done, each one of the heirs received a check for a little over $5,000 and the estate was gone. I hate probate. And so when we teach a class, we spend a lot of time teaching you how to use trusts, how to fund trusts. Even I would say that 90% of you, if you have a trust, according to the American Bar Association, 90% of your trusts have never been funded or not funded properly, which means the trust is there, but it doesn't own the assets. Those assets are going to go through probate, which defeated the whole purpose. Why? Because the attorney wanted to collect double dip and charge you for setting it up and also walking you through probate. Or your assets changed, and since the attorney set them up and you didn't take the time to fund the, we're going to spend a lot of time at the summit teaching you. If you're interested in attending our classes, they're free. Um, we but they're serious classes, and what we ask is if you're going to attend a class, you give us 3 days. Don't come in and learn half a strategy and think you're all powerful. It's going to kill you on the taxes. It's going to kill you, especially on the asset protection side. Okay, capital gains. I'm going to hit that, and then we're going to talk about some entity structuring that'll save you money on taxes. Again, I'm not going to cover lawsuits protection. We're going to have to save that for another time, although that really is our specialty. There are toll roads and there are free roads in the capital gains. If you want to pay the toll, there it is. It's in anything under short-term capital gains, anything under a year and a day, you're going to be paying taxes at your ordinary income tax rates. Long-term capital gains depends on your income, and then plan on, there's going to be a state. Most of you live in a state with an additional capital gains tax. So let me show you how this all adds up. You're all real estate investors. Let's take a dollar bill. We take it and we double it. One becomes two, becomes four, becomes eight, becomes 16. We just double it. How many times do we have to double it before it becomes $1 million? And the answer to the question is 20 times. Is it possible in your lifetime that you can double your money 20 times? Yeah, absolutely. You're in real estate. That's what we do. We flip houses. We hold properties. We invest in the stock market. You get a good education and you learn how to make money. And absolutely, can we make money? Yeah, yeah. Can we double it? Yeah, yeah. But remember that was without taxes. Let's take the lowest tax rate, and let's take our dollar bill and play a game. We take our dollar bill and we're only paying 15 cents, 15%. So we're, instead of having $2, we're going to have $1.85, and we paid 15 cents in capital gains taxes. Okay, and most people aren't too ticked off about that, because we have a military, and we have school systems, we have road systems, and we got a lot to do, and we do some charitable stuff with okay, so nobody's really ticked off about paying 15 cents. But then we take our $1.85, double that, and take out 15%. So we pay 28 cents. And now we just run the numbers. We double it, and we take this. This isn't funny math. We're just doubling it and taking out 15% every time. But what you'll notice is at the end of 20 trades, instead of having $1 million, you've got $220,000. The long-term effect is you never accumulated significant wealth because you didn't have enough money working for you. Now are you mad about paying capital gains taxes? Dang! Yeah, you should be. I mean, let's not storm the Capitol or anything, but yeah, you ought to be. Yeah, that didn't work out real well. But let's stop paying capital gains taxes. But that wasn't the whole story either, because again, most of you live in a state with an additional capital gains tax. So let's say I lived in Arizona and I flipped some property. I don't know, whatever. I sold a house. Their capital gains tax is only 1.87% additional, but instead of having $1 million, I'd have 179,000. If I lived in Pennsylvania, I'd have 154,000. If I lived in Oklahoma, 131, Rhode Island, this is not going a good direction. I hope you're seeing that. If I lived in New Jersey, 66,000, California, yep, 49. You understand it's the same amount of work. You fix the fence, you flip houses, you get in and you study the market, you're changing the carpet, you're mowing the lawns, you're doing everything you need to do. And at the end of life, you're either going to have $1 million or you're going to have a pittance. The choice is yours. Remember, I told you most real estate investors are not understanding the power of retirement plans. You're not putting enough money in because I didn't understand them. I didn't want to take the time, and you spend all of your time doing this and not having anything to show for it at the end of your life. That sucks. And I hope you're getting to see you've got to start using retirement accounts or some type of free road. When we teach a summit, we traditionally teach 11 different ways to avoid capital gains taxes. Some of them as simple as number 5, upstream planning. Okay, I've got this commercial building. It's now where I bought it for a song, fixed it up. Now it's worth $1 million. I don't want to pay the capital gains taxes. My dad's 90 years old. I gift him the property. Okay. When he dies, and I do a deed that is a transfer on death deed. As soon as he dies, it's not going to go into his regular estate, and none of the other kids are getting involved. As soon as he dies, I get the property back with a step up in basis, and the capital gains tax just went away. Some of these are simple strategies. You might not need a family foundation or a charitable remainder trust, or can you sell your business and not pay taxes on it? Yeah, it's right there in IRS code section 1202. There's so many free roads. Stop paying capital gains taxes along the way. And some of you ask, well, should I have a Roth or a traditional? It doesn't, to me, it's not going to ever be $1 million if you're paying. I don't care. But yeah, I'd rather you pay tax on the seed than on the harvest. But either way, a tax-free environment. You flip and flip and flip, and you buy and sell, and it's never going to be $1 million if you're paying taxes along the way. Okay, let me tell you just a little bit about our class, and then I want to talk to you about legal structures and how that can save you money. Our 3-day class, we've got one coming up in September 23rd. All of our classes are Monday, Tuesday, Wednesday classes. I know that that's really tough, especially when you've got jobs. The theme of our class is a lifetime to accumulate, 3 days to protect. Give us 3 days. We're very, very good. We're going to bring in the very best experts that we can. Look at our Facebook and our Google reviews, and you'll see that over 1,000, almost 1,100 5-star reviews. Look at their reviews. Well worth the time we spent. Best instructors I've ever seen. Best conference I've ever seen. Look at those 5-star reviews and sign up for that class. And Charles, would you mind putting that link, protectwealth.com/MPI, in the chat screen, and do the HTTP:// dash first, so it becomes a link, and that way they can just link on it, and that will get them there. Okay, let's talk about. I'm not going to talk about legal structures or lawsuit protection. But I will tell you that the most common question that I've had 25 years of running a hotline is this. Here's the most common question. Is students come in, they're real estate investors, and they go, well, what is the very best legal structure for a real estate investor? And I understand the confusion. Well, should I have a land trust or an S corp or an LLC or a series LLC or self-directed IRA, or how do I do this? And I wish I had a really simple answer, but the answer that I'm always going to give is it depends. But I'm not being coy and I'm not being funny. But let me tell you how complex this is. Let's just take, Here's the questions I'm going to turn around and ask you. And if you go to your accountant and say, what's the best legal structure? And he says, we'll have an LLC. He, he's not asking you the right questions. Here's what I would ask you. Do you want to flip or do you hold? Because one has liability, one does not. One is active income, one is passive income, and you better know the difference. Are you going to own the title or the note? Again, one brings liability, one does not. Are you using qualified retirement funds like 401ks and IRAs? But that's a big difference. Are you using leverage? How much leverage are you using? Where are the properties located? Where do you live? Okay, that's a big one, because capital gains taxes can kill you, and your state taxes very, very different. Are you using syndicated funds? Are you using other people's money? Are you going out and looking for funds? That's all puts you in a whole different realm. Are all the investors US citizens? Well, that would prohibit you from an S election for your LLC. Are there big startup costs? Did I spend a lot of money for trainers and workshops and classes? If so, we're going to structure you differently than if you didn't. Do you plan to sell this business, or are you just going to acquire wealth for yourself? Let's take the simplest one and let me break it down for you. Do you want to flip or do you want to hold? What's the best legal structure if I want to flip? Well, if I'm holding, here's the issues that I see. Um, I'm worried about you. I'm worried about resident safety, because 64% of your lawsuits are going to come from not keeping your residents safe. I'm worried about your property manager screwing up. I'm worried about maintenance concerns, and I'm worried about protecting equity and simplifying paperwork. If you've got 27 properties, do I need 27 LLCs and 27 bank accounts? And oh my gosh, how do we simplify this? What about the due on sale clause of your mortgage? If you have a mortgage, you signed a little document, and there was a paragraph in that mortgage that says, if you ever transfer this out of your name, like to an LLC, we're going to call the loan due. How do we get around that? I'm worried about depreciation deductions. Some things like FLPs, family limited partnerships, I could put my properties in those and lose my depreciation deductions or passive losses. What about real estate transfer taxes? Because a lot of you live in a state where there's real estate transfer tax or a mortgage tax. There's a mortgage on your property in Florida, they're going to charge you an additional stamp tax for that. Those are the concerns that I see. If you're flipping properties, you got very different concerns. I'm worried now about construction liability. I'm worried about contractors, subcontractors not getting paid. I'm worried about buy-sell agreements and the contracts and the liability that poses. I'm worried about capital gains. I'm worried about dealer status, like we mentioned with Bob right at the very beginning. You losing your long-term capital gains rates, losing depreciation deductions, all of those things we talked about with dealer status. Those are the issues. If the concerns are different, don't you think what I'm going to suggest for you for legal structure would be different? And if your accountant does not own real estate, he does not understand the complexity of legal structures and what needs to go into your LLC or corporation, or should it be an LLC or should it be a corporation? I don't know. Let me show you how we would structure normal deals. Let's say you've got 3 investment properties. And going back to the question that AJ asked, let's say I've got an operating company. Should that be an LLC or a corporation? Depends on your tax bracket. It depends on the state that you live, but one of those two. It would be taxed as a C or an S. We'd never tax that as a sole proprietorship. We would never tax that as a partnership. The holding companies, in this case, we're using multiple LLCs, multi-members, so that you've got good charging order protection. But the stock of my corporation is I'm gonna be the shareholder all the days of my life, but I'm never going to issue the stock certificates in my name. I would issue them in the name of the trust, so that if I die, the corporation isn't in limbo. Clearly, there's a trustee that now owns it and controls that. It's absolutely instantaneous. There's no limbo for that. I take all the LLCs, my ownership. I own 50% of this, 40% of this, maybe 90% of this. Upon my death, I'm the member all the days of my life. Upon my death, it goes down to my trust. There's a clear succession plan. The only problem with this is that I've got 5 tax returns, my individual 1040, one for the corporation, one for each one of the partnerships. What if we can simplify that using this structure? Oh, we could do that. And some of you, if you lived in California, should that corporation, that the management, should that be an LLC or should it be a corporation? We would say in California it would be a corporation because you're taxed less on corporations. If you were in Arkansas, it would be an LLC. If you had a lot of startup expenses, it would be a corporation. If you didn't have any and you are never planning on selling the business, it would be an LLC. Do you see? It becomes a little complicated other than, and again, I'm not trying to be coy, but it depends on you and your situation. And if your accountant doesn't understand this, your attorney doesn't understand it, clearly they're not in the right game. Everything flows down to the trust. So I'm taking all the tax advantages out of the corporation that I can possibly take. The multi-member LLC, the hub in the middle, I might use a Wyoming for that, or a Delaware, or a Nevada, something with really strong statutes that even in the worst lawsuit, they can't take it away from me. It owns 100% of the single member LLCs. Those are located wherever the properties are for standing. So that my Indiana property, I've got standing in that state. I can evict tenants, but who owns that? I don't know, some obscure Wyoming holding company. That's me, but nobody knows that. If I'm flipping properties, my structure would be very different. I'm separating the flips from the holds. We've got hundreds of these little diagrams depending on what it is your situation demands. This is what we teach, but always tie everything to everything down to taxes. Let's go back to this. If I'm flipping properties, I would set it up a single member LLC solely owned by the corporation. When that property is sold, I dissolve that. Nobody can sue a dissolved LLC. I go to the next one. When the property is sold, I dissolve that. Flips, we always tie tax wise to a C or an S corporation, but we would never tie holds to a corporation. We would never put a hold property in an S or a C. You lose all the depreciation deductions. You lose the step up in basis. It would be tax wise, it would be a really stupid decision. That would be taxed as a partnership or a disregarded entity. I hope you're seeing that it's not always, for me, it's simple, but I've been teaching this for 25 years, and the people that we were bringing to the table understand the tax game as it relates to entity structuring. And I'm not going to go through every one of these. You get the idea. I told them I would only take an hour, and I've taken an hour and 5 minutes. There's so much more. I'd love to teach you how to create anonymity in your structures. The best states to incorporate probate and estate taxes. We'll have to do 4 and 5 on another webinar. How to fund your revocable living trust, how to maintain your business entities. You have a corporation, are you keeping your minutes and meetings and resolutions and stock certificates and stock ledgers? If not, they're going to pierce that and come right after you. Is your home protected? That's a whole nother webinar on that. We're going to teach what the next 2 events coming up, September 23rd and then November 11th. We would love to have you attend. This is a free workshop, but when we say it's free, it does not mean that we're not going to put our heart and soul into teaching. We are, and it does not mean that you can come in and out whenever you want to. I wish this was like a college class. If you're late, we slam the door. I can't do that on a Zoom event, obviously, but we do want you to take it seriously. Again, a lifetime to accumulate, 3 days to protect. You would go to, yep, the link that Charles put in there, protectwealth.com/MPI. And if you're a professional If you're a CPA, if you're an attorney, almost always you're going to get continuing education credit for that. This is a serious class, but it wasn't designed for them. It was designed for you, the real estate investor, the small business owner, how to protect assets. This is what we do. Our name is Protect Wealth Academy. We've got hundreds of videos on YouTube, but our premier event is the 3-day summit. Encourage you to sign up. Charles,
Awesome.
how's that?
Don, that was so awesome. As I mentioned earlier, this class was definitely personal for me because this is something that I believe in doing. This is an area that I believe that I can grow in. And I think many of the people on this call and all of the people who are going to watch the replays, I think they're really, really going to get something great out of it. And just so you know, I signed up already for the November class. I wish I
Good.
could do the September, but I don't want to get in trouble with you for missing a session just because I can't do all the days in September. But I just want to encourage you all to make sure sign up for this class. I mean, this is like people charge a lot of money for these type of classes, and Don and his team are literally gifting this class to people to spread the education. So I'm going to encourage you all to do that. Also, too, Dawn comes to at our events, the Real Estate Wealth Builders Conference. So come and meet Dawn in person. And so I encourage you to do both. Go to the sessions online and then also come and meet him in person at our events. So thank you all for coming. Dawn, thank you once again. And I'm looking forward to part two.
Well, thank you very much. Well, what questions do we have? And did I create any questions through the process? Or did everyone understand everything we talked about? Or did I create more questions than you came with? You're welcome to throw out whatever questions. I don't think I saw the first ones.
So yeah, I think you
Um,
answered all the questions so far. The only question that we have in the chat, AJ also asks, he asks, is there going to be a recorded version of the summit available, even if we have to pay for it?
the summit used to be a $3,000 class. When we could do this on Zoom, we don't have to travel. We don't have to buy cookies and coffee for everyone. We didn't have to bring in all the speakers, so we made it a free event. Is it going to be recorded? No, it for compliance purposes, but we don't record it and make it available to students. The problem we had is people were cutting it up and posting it and saying things that we would have never said or saying things out of context. And so we, I'm sorry, we can't do that. Um, and I know it's a sacrifice to do it on a Monday, Tuesday, Wednesday, but I cannot bring in the firepower we bring in, the attorneys, the CPAs, the incredible people. We can't bring those in on a weekend. It just doesn't work for their schedules. So I apologize for that, but it will not be the recording will not be available. How's that? What other questions? What are you guys facing? What are you doing um, that that maybe brings liability to you or brings taxes? Questions.
So, yeah, come on, you all. I'm sure some of you have some good questions.
Great. AJ, it'd be great to have you there. Thank you.
Awesome.
Well, I guess we've done our best then.
Yep, yep. You explained it so well, Don. That's the thing. When you explain so well, then you just, leave room for no questions, man.
You know what? And sometimes it really, and we're going to try to cover a lot of the state specifics. And if your properties are in Texas, we might consider a series LLC. We would never do that in California because California Franchise Tax Board is going to want to charge every one of the cells in your series LLC an additional $800 per year. In Pennsylvania, we're going to use sleeper deeds. We're going to use unrecorded deeds. We call them a dresser drawer deed or a ladybird deed to transfer the property in, or you're going to pay a huge transfer fee. In Texas, we're going to do things different. We're, Arkansas does things differently than Oregon because they require the LLC, the members and the managers to be disclosed. And so we might use a statutory trust. in a land in Florida, we might use a land trust because their laws are, well, Louisiana is really funky, but um, you've got some great laws for land trusts in Florida that we wouldn't have. But so we customize this for you and what it is you're doing. There is not a one size fits all for the tax and legal. I hope you're seeing that. And I, Charles, I can't tell you how many students have called. In fact, last week somebody called from Florida. I've got 20 rental properties, all 23 rental properties, all in my single member LLC. Why did you do that? Because my accountant told me I've got good protection. No, you got good corporate veil protection. If something happens, they're going to come after. They can't come after you. But if you run over my daughter, I'm going to come take all your properties away from you. Are you kidding? But sometimes you're getting some of the worst advice. We're going to give you advice from seasoned investors. No need. Very informative. Thank you. Okay. Charles, what else? Anything else? Are we done for the night? And it's late time where you are, isn't it?
Yeah, but it's all good because I have fun with real estate, tax, anything like this, I will definitely enjoy and devour it. So, but I'm really looking forward to this event as well too. Just to kind of, learn from you all. You all have been doing this for so long, and so at this event, are people able to give like specific examples and situations when they ask questions, or that's a part of your coaching program?
Like if Clint Coons is teaching, he'll have two or three attorneys in the background just answering questions. If we bring in Jill Banner, who owns an IRA company, she'll have two or three people in the background just answering questions for you. And so we try to do our very best. Sometimes that we really need to know a lot more about your situation. And so, the same general disclaimer applies. I don't know enough. So sometimes we need to get a lot more specific detail, but we bring in some major firepower when we teach these classes.